Hi everyone, this is Dimitri Pergamonic with MarketChameleon.com. I wanted to really quickly talk about trade conditions, and I'm going to use the option block trade screener in this example. So what you see down here is a bunch of trades coming in for different symbols. These are all options trades. This is the description of the option. And just like stock, they get reported on a tape, and typically what you see is the price of the transaction and then the quantity of the transaction. That's typically what you see reported. But if you look at the trade tape, there's a lot more information on that trade tape, and sometimes it can be very insightful. I'm going to just focus right now on the trade condition, the actual condition of the trade that got reported with the trade. And when you come down here, if you scroll down to the bottom of this table, these trade conditions are described below, so you can read about them. Some of them I'm not going to talk about much. You can read about them because you don't see them popping up that much. It's either something happened out of sequence, maybe there's a correction in the price, and they'll indicate that on the tape. But I'm going to just concentrate on the trades that come up more often, that are more significant. And the first two that you see up here is a regular trade, which is just a typical trade. Somebody either bought a call, sold a call, bought a put, sold a put. Once it got matched up, it got reported on the tape over here, and then you get to see the exchange that it traded on. The auto execution, it's very similar to a regular trade. You could come down here and read about it. The difference is it got executed electronically, automatically, and it's processed like a regular trade. So that's what happens on an auto execution, and that could happen if a broker sends in a trade electronically to an exchange. The exchange may have had a price improvement, or it just got matched up right away electronically with another order. Once it gets matched up, it gets printed on the tape, and then it gets that trade condition auto execution. Intermarket sweep, this is a more interesting order type, and what this is doing is when somebody enters in a more aggressive order or market order, they'll enter it in sometimes and designate it as an intermarket sweep order. Now, what an intermarket sweep order is, and let me just make sure we have the definition over here. What this does is, let's say you have an order that you want to execute 50 contracts or 100 contracts, and you want to send it to the market. And since you're guaranteed the best price, what happens is it'll first go to the exchange that is displaying the best price. So for example, if you want to buy an option and one exchange is displaying the best price, it's offered at $1, and everybody else it's $1.05, so above it. The first thing you'll do is go and try to get it for $1, and then after that it'll go to the next price, $1.05. Now, if you're trying to buy 100 shares, 100 contracts, and there's only one offered at $1, what happens is that you do risk that while you're going to one exchange to get it for $1, the markets can move and everybody else's. So you get that one contract at $1, but everybody starts moving higher to $1.10, $1.15 because maybe the stock is running. So then you end up the other 99 contracts, you have to pay a higher price. So an intermarket sweep, what it says is, I don't care, about the dollar. I want my order executed immediately on the top of each of those exchanges. So it'll go get the $1.05, maybe $1.10. So what it does is sweep the top of the book on all the exchanges. Now, of course, if one of the exchanges has 100 at $1, it'll go there. But that's what an intermarket sweep order. It's a more aggressive order where you want an immediate execution, and you're willing, even if you have to trade through the $1 first to go to $1.05, that you will do that because you want to make sure you get your execution quickly. That's what an intermarket sweep order is. Now, a spread order over here, and I'm going to just come over here and let's just screen out all the spreads. So here in the trade condition, if I select spreads, it's only going to show me spreads here. And this is when the trade involves two parts. You're buying one option, selling another option. So you could see here, over here, spread and spread, both were on the Amex. You see both here at the same time, 328.16, 328.16 in AMD. So over here, so this 50 contracts was on the October 11th expiration in a 30.5 put. This is the other part of it for 10 cents, 50 contracts. This was on the October 11th 30 put. So that was a spread. He bought one, sold the other, and that's what a spread trade condition is. So whenever you see a spread, you're going to try to go and find the other piece of the trade. So over here you could see, something happened at the same time in the same stock on the same exchange, and that's how you would match up a spread. Now let's take a look at another type of order, which is a stopped IM order. Now what this is when you send an order to an exchange, sometimes what happens is, let's say you send it to the CBOE, but a different exchange is shown a better price. Now the specialist could just say, I'm going to go try, on behalf of the customer, I'm going to try to get the better price on the other exchange, but I'm going to stop the order so I guarantee it doesn't get executed below this price. So what happens is that customer is already guaranteed the price because he stopped out at that price, while the specialist goes and tries to get that fill on a different exchange that's displaying the better price. So that's like a stop IM order. And let's just go down here and see transaction was the execution of an order which was stopped at a price that did not constitute a trade through another market. Now let's just go down the line. A combo, it's similar to a spread. There's more than one leg to the trade. So we could see here CVS. It doesn't necessarily have to be, a buy and sell within the same series. So look at this one in CVS at 247.34, 247.34. Two trades happened. One was in a November 64 put. The other one was in a November 1st 63.5 call. So you could see here 100 of these traded, 100 of these traded. They were both, the trade condition was a combo, and they both traded on the Philadelphia Stock Exchange. Of course, there could be even more than two legs to the combo, and one could have been a buy, one could have been a sale. You could also go cross months. I don't see any right now, but maybe right here in GE, some of these could have gone cross months. So a combo is similar to a spread, but it doesn't necessarily have to be a buy and a sell in the same series. It could go a call and a put, or you could go even cross months and different strikes. So that would be a combo trade condition. Another one, we could take a look down here. I think I saw a straddle. So straddle, that's similar to a spread, except you're either buying a call and a put or selling a call and a put, right? So here's a straddle. Over here, we see in Citigroup at 332.59, two trades happened. They were both trade condition straddle. So 168 of the calls traded for $1.72, while 168 of the 65 puts traded for $1.90. So these two are part of the same trade. Now, on the next one that I wanted to mention here is a buy right. So this is a buy right condition. Now, this here is not a buy right, what you would imagine like a cover call. The way the exchanges identify the buy right, this buy right condition is that it's an option with a stock component tied to it, but it doesn't necessarily need to be one for one. So see here, transaction represents the option portion of an order involving a single option leg, buy or sell, and shares of stock. So over here, what we do see is, since it's say buy right, there is a stock component to it. It doesn't necessarily mean that it's 1-for-1. It could be a delta neutral trade. So, there's 68 contracts here. That doesn't mean there's 6,800 stocks, a stock component to it. It could be, it could be less, it could be more. And really, how to match that up is you want to go to the contingent stock trade screener. And whenever there's a buy right, that means there's a stock contingent. So if you go over here and see, these are all the contingent trades. I think we looked at GE. So you would match up GE at the same time as that option, and you'll see. So that one was 1-for-1, the one we just looked at, 6,800. But that's where you would go and look at then you would have to go look at the stock tape to see what traded on the stock tape to match up with the option tape when it's designated buy right. So that's how you would start looking at the trade conditions when you're looking through the option trades to really identify, well, what is this? Is this a single trade? Is it part of a different trade? How did it trade? Was it an auto execution, regular trade, intermarket sweep? And this gives you a little bit more information about the trade and what transpired, and then you could paint yourself a bigger picture using all these details that are available to you. Hope you guys liked the video, and see you next time.